So a quick high-level introduction to Slauson Co. We are an early stage venture capital firm. We're now deploying capital from our second fund of $100 million. Our first fund was 75 million. We made 38 investments. So we have 38 portfolio companies. Our two primary areas of investment on the B2B side is SMB tech, so tools for small business owners. And then on the consumer side, we like to focus on digital products and services that are super serving overlooked customers, typically leading deals investing across the US. We also have an accelerator called Friends and Family, where we're investing 150K for 5% ownership. Those 20 companies that were selected for this year's cohort just started the program last week. It's a 12-week program, so 3 months. And that's a quick introduction. We'll share a link to learn so you can learn more about us. If you have any details, you can also reach out to us on our website. Our team reviews all entries that are shared there. But without further ado, we're going to get into today's conversation. So again, the topic of today's fundraising strategy, specifically with regards to the round itself. We'll do some quick intros from the audience. We'll talk about the round dynamics from our perspective, how we view the difference between pre-seed and seed, which this changes. So this is our perspective. And then some things you want to be mindful of as you're heading into fundraising. And then again, we'll open it up to Q&A. We'll get into the rest of today's topic. And we'll start off with round dynamics. Again, this is our firm's perspective on this. We would welcome folks to share their perspective if they've come across different firms. You don't have to share firms' names, but just how you might have seen this approached differently. So when it comes to the actual fundraising round, there's two ways to think about it. One is the qualitative aspect of it, and then the other one is a qualitative. On the quantitative side, as a firm, what we take into consideration is how much you've already raised and the terms. So why that's important is because it has implications for dilution. As investors, we don't want to come into a company that's already taking a substantial amount of capital, because that us doing so means that that company will have to raise another round at a much higher valuation in order to account for our dilution that we're investing in this new round. And so we often like to ask or understand, if it hasn't been shared, how much the company has raised. Typically, what you usually see as a rule of thumb is each round is roughly about 20% maximum dilution. You can do 20% plus minus 5%. But again, if that's on the higher end, you want to be very careful what you're setting yourself up for in terms of the following round. But we take that into consideration. As another example, we've seen a couple of deals or we see deals where a company has taken $5-6 million, and they're talking to us as seed investors. And if it's interesting, we'll have the conversation. But typically, at that stage, us as a firm investing $1 to $2.5 million into that company is not going to make a big difference. Those firms should be raising $5 to $10+ million. That's the reality. The other catch is, do they have the ability and are the metrics strong enough for them to do so, which is another part of the equation. So that's the first bullet. On the second bullet, we want to consider how much they're raising, how much they're planning on raising, or are raising, in fact, at this moment in time, let's say whenever we're having a conversation with them. So if we typically hear the amount, we can sort of back into what dilution or valuation expectations the founder might have. So it's very different for a founder to say, I'm raising $1 million, than another one that's saying, I'm raising $5 million. Quickly, we can figure out what sort of signal that's sending, coupled with how much they raised before. A company that's raising, let's call it $5 million, the expectation would be that they probably likely have already raised some amount of capital and are likely much further along than the company that's raising $1 million. And so we try to figure out how is this round appropriate to how much they're already raised and how much dilution they may or may not be expecting. The third point is, again, all related in terms of where the company is with regards to its traction. So if it has revenue, we want to understand the underlying revenue drivers in terms of growth, in terms of number of customers, et cetera. And then if the company is pre-revenue, we want to understand other metrics of growth that hopefully can be a leading indicator that whenever this company does start monetizing, that it will be able to be on a strong trajectory in order to grow the business at a rate that venture capital needs for it to grow at. On the fourth point, you actually see this bullet. I have it in both a quantitative and qualitative because there's a little bit of nuance when it comes to the market size. So there's generally you can fairly quickly do the market sizing based on what's real. For example, if you're creating a car wash company, you can just quickly look at how many car washes exist in the US. And then if you're charging each one a certain amount, you multiply those two numbers. That, in theory, would give you your market size for that, for whatever company you're building in that space. On the qualitative side, it's maybe where you're starting a company in a completely new industry, or you're trying to create a new category or a new sector. There, it's much less. You already look up the number of potential customers. I mean, you still want to understand who you're trying to sell to, but there's a little bit more nuance there. On the exit potential, this is important, particularly as it comes to what type of scale the company is likely to reach and or your interests as a founder. The easier example is when it comes to CPG, which we are investors of. We have some companies in that space, but generally speaking, when it comes to CPG investments, you want to understand what the long-term success is, again, for you as a founder and then for the company. Because that will dictate if the fund might be a good fit for you. So really quick, high-level math, a venture firm wants to ideally have every investment return its fund. So our first fund is $75 million. We're looking for our investments, let's say in one company where we own 10%, let's call it, we want that investment to return us $75 million at a minimum. And so quickly, if you do the math, we're looking for an exit of $750 million at a minimum. Much larger is better for all parties involved, the founder, us, our investors, et cetera. But depending on the space, again, I'm picking on CPG for right now, but being able to get an exit that high may be challenging depending on what sector you're operating in. You can look at previous companies that have gone public or previous mergers or acquisitions in the space to fairly quickly figure out what are the sizes of companies that this industry can sustain. And if that's not companies that are north of $900 million exits, it might be better for you to talk to smaller firms, aka sub $75 million firms, because again, we're trying to look for that type of an outcome. Any questions on the quantitative aspects of these bullets?
Yeah, I'm curious. So on the $75 million round, just that hypothetical, the LPs are expecting what, like 3x of their money or like 5x? Like what kind of pressures are you guys getting from LPs?
Yeah, so thanks for the question. So $75 million is our fund. If we're investing in a company, let's say to make this math simple, a pre-seed, we're investing in a pre-seed deal, we're putting in 750K and we're taking 10% ownership in that company. So that company's valuation is $7.5 million. But to answer your question, in terms of our goal, it is to at least 3x our capital so that we can return capital to our investors. So I said at a minimum, we're looking for the one investment to return our one fund size of 75. But the hope is that we are able to accomplish that same thing with multiple investments. So we have 38 portfolio companies in our first fund.
Yeah,
We're hoping that 2 to 5 of those are return at least 1x, but ideally multiple X's of our investment.
got it. So you guys do, you mentioned the CPG, you guys do invest in non VC scalable companies.
Yeah, I mean, it depends again on the industry, and
Yeah.
it depends on some of these quantitative and some of the qualitative. It is the minority of our investments, but we'll take a look, and we were not against CPG investments. Okay, so we'll get into the qualitative considerations. And I will say with each of these categories, we could have a whole nother Slauson Spaces, and we might as well, just to dig into each one of these. But for the team, a high level, we want to understand who is building the product, what are the relevant backgrounds. One of the things that you often hear us say is your lived experience is your competitive advantage. So we want to understand how is your background, your history, tying into what you're building and driving that. Who else is building the company with you? Who else? We care a lot about the fact that you as a founder or founders are able to attract the top talent to work with you. And so if you are able to show that by getting people to work with you, whether directly full time or as advisors or as part-time contractors, et cetera, and they themselves have a lot of relevant experience, that bodes well for what you're building. Second, on the product, we want to understand what the actual product does. Who is it serving? What unique insights do you have because of your team's lived experiences and backgrounds that are driving the product that you're building and is going to, again, super serve and create value for the customers that you're gonna reach. And then the third bucket is the other side of the same coin when it comes to the qualitative metrics, the market size and exit potential. Sometimes your industry is newer than other industries, and you want to help show to the investor why the market is large. So tying into the numbers that we were just throwing around, whenever we're doing a market sizing, we want to see that the market that you're trying to go after is in the billions of dollars. If your market size is in the hundreds of millions of dollars category, that doesn't mean it's a bad investment or would be a bad venture for you to build. But from a venture capital perspective, venture capital specifically might not be the best financing tool or vehicle for you to go after. Um, so we'll jump into the next slide, which hopefully will demystify a little bit pre-seed versus seed with a couple of different asterisks. And again, this is how we view these two categories. So when we're talking about pre-seed deals, valuation ranges hover around $5 to $10 million. You can do plus minus 1 or 2 million in there as well. Anything below this, you're likely talking about accelerator terms. And then if you go above, then you're talking about seed rounds. And again, a lot of this is tied into the dilution that you would be taking if you are raising a new round of capital. We as investors want to make sure that companies are incentivized to see this company for the long run, and the way to do that is to make sure that they have enough equity. So valuation, that's a rough range on the round size. For us, we view anything below 2 million roughly to be pre-seed category. Again, there's nuance on TechCrunch, which I'm sure you all have seen it. You see 6, 10, 50, $100 million seed rounds. Those are typically the ones that get the features because they're anomalies. And so roughly the range in terms of dollar amounts that you're raising, we would call it somewhere between 750 to 2 million. This likely means that you've raised some amount of capital, likely below $500,000 in what some people call a friends and family or angel round. and you're going out to raise another round again in this pre-seed title. And in terms of how,
Jesus,
sure.
can you advance one slide? We're still seeing round dynamics.
Oh, I had my other screen up. Thank you. Thank you. So yeah, valuation range 5 to 10 million, round size 750K to 2 million, and you've likely raised sub 500K. And in terms of what you're hoping to accomplish with it, if it's a pre-seed round, it's in our perspective, slightly different expectation than if you're raising a seed round. Reason being, the goal of a pre-seed is to get you to that next round as fast as possible. And typically that would look like hitting your milestones in about 12 or so months. And so you want to understand, even going into the fundraise, what are those seed milestones that I need to hit? And that way, what you're raising will ideally enable you to raise that much. The other side of this coin is if you raise a pre-seed round and you're building for 3-4+ years, generally speaking, people are going to ask, well, what have you been able to accomplish? Something might not be working. And so you want to show that, hey, we built out the product, we hired the team, we expanded into these markets, et cetera. And at the seed round, you're raising a substantially higher amount of capital to reach some new targets. Maybe I'll pause quickly on the pre-seed, see if anybody has any questions.
Hey, Jesús.
Mhm.
I have a question. Sorry, I didn't raise the hand. I couldn't find it in all the.
All good.
But so seed round. So I'm kind of trying to work backwards from seed to pre-seed, right? So seed says forward milestone is 2 to 3x year-over-year revenue growth, right? And then pre-seeds, we have forward milestone should be raise a seed within 12 months. So what's the in between? Like if you're going from pre-seed to seed in the current market, what's that kind of ARR threshold around which you start to make it likely that you can raise a seed?
Great question. So, a couple of asterisks there. One, it depends if you're B2B or B2C. I'd say if you're generating revenue in this market right now, if you're raising a seed at a minimum, if you will, in terms of MRR, so monthly recurring revenue, where you should try to be is around 40K MRR. The higher, the better. If you're hitting 100K MRR, then that's that's very strong grounds for not just raising around, but raising around at whatever valuation you want from different firms, and ideally having multiple interested parties. So anything I would say from 40 to 100K MRR, you're in good territory. Now, again, that's just on the revenue growth. There are other components of the business that need to also be intact. But to answer your question, that's one way to look at it. Hopefully that's helpful. The other asterisk I will say is that it's not always the case that you have to raise a pre-seed round to raise a seed round. Now, that might sound like, what are you telling me? In the sense that you might raise a 2.5 or a $3 million first round, and that might be what you have. And hope that said, the hope is that if you raise that round, then there's higher expectations because of the dilution that you took for that around what the following round will be. Hopefully I'm not confusing you, but again, if you took, let's say, a $3 million first round of capital, and you gave up 20% of the company, so quick math, that's $15 million valuation, and you're right, and whenever you go out to market to raise another round, you better hope that you are that the business is at a stage where it can raise off of a valuation that is ideally much higher than 15 million. And so you want to make sure that that's true. We have a question, Justin.
Yeah, you kind of hit on it in the end. I was going to ask what, so less than 750 raised is what, my question was, what do companies normally come in terms of like amount raised and dilution before pre-seed? And if there's any, like, what would be like a red flag?
So maybe just to clarify, 750K to 2 million is how much you're trying to raise in that round. In terms of how much you've already raised, again, if it's a pre-seed round, it's likely sub 500K. Typically, we're seeing like 1 to 250K is probably more of the range. Now, if you're raising a seed round, assuming that you've raised, call it a pre-seed round, that's higher than 500K. The soft distinction there, Justin, maybe it's helpful, is the soft distinction is if you've raised from an institutional venture capital firm. So if you've raised a round of capital, 500, even if it's 500K or $1 million, and then you're raising a $3 million round, it's likely that someone will call that or classify that as a seed. And in terms of dilution expectations, again, rough rule of thumb, 20%. But if you're raising a seed round, in terms of red flags to your question, if you've raised probably more than $2 to $3 million going into that seed round, it's not necessarily a red flag automatically. The reason I say that is in this environment, for better or for worse, we're seeing a lot of down rounds and or recaps. So just what that really means is that somebody raised a round, let's say at a $25 million round 2 years ago, and they're going out to market right now and expecting or are raising at half that valuation.
Mm.
So that's not an ideal case scenario, but it is what we're seeing right now for a couple of different reasons. One of them we'll get at on the next slide. But yeah, red flag, typically well north of $3 to $4 million going into that raise. But again, it's not automatically a red flag. It's probably more of a yellow flag, and you want to understand what's happened.
Got it. And then on the pre-seed, like, what would you expect to see? Like, let's just say we did friends and family or angel at 150 to 200. Is it like, would you expect to see like 5% or like what would be? Yeah, I guess that's my question. My second question.
Sure. So that really depends who you raise from. So the easier example, which we often see, is like an accelerator. So if you look up any accelerator terms, typically you're getting anywhere from 20K to 150 or even up to 200K from these organizations, and you're giving up somewhere between 5 to 10% ownership. So that's probably a good rule of thumb. So to answer your question, you're raising sub 500K, it's probably no more than 10% ownership.
Thank you.
Yeah, no, thank you. So maybe on the last bullet for the seed, so for forward-looking milestones. So this is at a point where you are trying to, let's say you're post-revenue, you've had some traction for 5-6 months. You're really trying to raise enough capital to last you, let's say, 24 months, so that you are able to show some sort of strong year-over-year growth. And that's not just the only metric that matters. It also matters what's underneath that in terms of churn, how many customers stop using your product, in terms of growth, how fast you've been able to reach that revenue, and a number of other factors. But a quick rule of thumb is you want to show that consistent year-over-year strong growth. I'm going to move on to our last slide. Well, the last thing on the B2B versus consumer, to one of Paul's earlier questions. So right now, the environment we're in, consumer, is unfortunately not super in favor. There are still consumer deals being done, but I would say the expectations for those deals is a lot higher than they have been before. And that's just a reality of where we are right now. A lot of firms are not even doing consumer anymore. We're still doing consumer investments, but again, you want to be mindful of that there's this pre-seed and seed, but then it's different depending on your specific business and business model as well. So this is the last slide that we have for you, so that we can talk about whatever questions are top of mind for you all. So in terms of if I'm or any of us are a founder in you all's shoes, these are things that I would want to keep top of mind. We've already started to touch on a lot of these, but just to reiterate and reinforce them. So raising too much capital and not hitting the right milestones. So Ideally, if you raise a lot of capital, you are raising it from institutional investors, which can help advise you and guide you well in advance of you going out to market, for you to understand that it might be difficult for you to raise given what metrics you have, depending on where the business is. So as early as possible, again, even before starting to fundraise, you have a decent understanding of what the future metrics you want to hit and that are going to make you successful in raising another round of capital. Something that I borrowed from a founder I heard a long time ago. Whenever you are fundraising, is this round is always about the next round. So what that means is, as a firm, I'm looking for founders to instill confidence in me that if I invest in you in this round, you are able to accomplish what you're saying you're going to accomplish, and then ultimately raise another round of capital. Because it's very likely, I mean, companies that end up going public are raising 7+ rounds of financing. So it's not likely that you're only going to raise the capital that we're investing in and then you're going to go public in 10 years. So I need to have confidence that you understand what it is that you're signing up for. Now, if you're a founder hearing this, what's one way to do that? You can talk to investors, you can talk to other portfolio or talk to founders that have raised rounds, understand, ask questions, try to figure out what is the current market environment that we're in, for it to help you approach that fundraising round. So that's the first bullet. Second one is very closely linked to that. So how much you're raising and what are you trying to accomplish with it will have strong implications for the following round of capital. To our earlier point around a lot of down rounds and or flat rounds and or recaps, recapitalizations, that's recaps is short for that. These are cases where a company raised $5-6+ million and they were not able to hit the metrics that, at least in this environment, investors are finding favorable enough for them to put in another 5, 10, $15 million in what would be a Series A round. Let's say if it was a seed round, that prior round was a seed round, and they're not able to, but they need to, because that, call it $10 million round, would mean that they're able to raise at a 30, 40, $50 million valuation. And so because they weren't able to, for a number of reasons, I'm not saying that I'm not critiquing the company or the founder, but again, understanding the market reality of this day, of right now, they have to adjust. And what they're adjusting is the valuation expectations, their ownership, their dilution. And so I'm definitely not saying that that's a category that anybody aspires to be in, but it is where some founders may find themselves. So you want to be mindful of that. On the third bullet is being mindful of when you want to actually start fundraising. So whenever I first joined Slauson Co. Almost 3 years ago, it was peak of venture capital investing in terms of low interest rate environment, macroeconomic environment, a lot of capital to deploy. Deals I saw being done in a matter of days. Now it's months. So I'm not saying one is better than the other. I have an opinion about that, but right now, at least, if a round to get done is going to take 2, 3, 4 months, let's say, you want to make sure that you are planning backwards from when your cash out date is. So whenever you actually have no money to continue funding the business, you want to start earlier or as early as feasible, so that whenever you are finally able to close a round, you get that injection of new capital and you are not in a very precarious situation when it comes to your runway. We hear of people that raise and they have 1 week left of runway. That's, again, you hear those stories, they exist. There's probably even stories where it's like literally the same day you're gonna run into capital, you get a new investment. But for your blood pressure and different people's blood pressures, you probably don't want to be in that category. So be mindful of runway and make adjustments as needed. On the fourth bullet, you want to understand who you're talking to. And again, this could be a whole separate Slauson Spaces, but in terms of how to approach the right firms, I mentioned the quick math earlier and talking about our $75 billion fund one. So what our expectations are. The fund size, generally speaking, also has a correlation with their investment amounts. So our investment amounts for our $100 million fund are slightly higher than for our $75 million fund. So because we have a bigger fund to deploy, we almost have to make bigger investments than we were making if we were than when we were a $75 million fund one, which is also the same is true of about a $25 million fund, which is also true of a $2 billion fund. So you want to understand that firm's investment stage, investment checks, ownership expectations, et cetera, and then base your fundraising strategy accordingly. On this wildcard bullet, you again on TechCrunch, you hear and read about somebody raising $10 million that's pre-product, and you're like, what? I'm raising two. Why can't I get this 10 million? And that can be certainly frustrating. The reality is VC is all about relationships. And so there are cases oftentimes where a founder, let's say, especially one that had another startup, and let's say they had a successful exit, the amount of capital, the time that they're fundraising, and the valuation that they're able to get is going to be wildly different from another founder that's raising for the first time, even though that founder might have a phenomenal background. And that's just the reality of it. Investors are going to favor somebody who's has experience with running startups, or there are other unique circumstances where the round amount or any of these metrics that I showed on prior slides, these are rough guidelines, but there are always edge cases where you're going to see something that comes out of these. Other examples, depending on the time period, right now, or maybe not exactly this moment, but let's say end of last year, AI, very hot topic, infrastructure deals. You were seeing raising hundreds of millions of dollars in rounds. Those are, generally speaking, anomalies. Or whenever I first joined Slauson, crypto was highly in favor. And so those deals, again, generally were raising more capital than non-crypto deals at valuations that were higher than non-crypto deals. Did they deserve that? That's a topic for another day. But you want to understand what is happening in this current market environment. And again, a couple of ways to do that: talking to investors, talking to talking to founders that have raised venture, and getting their take on it. The last bullet is just, again, right now, 2021, when I first joined, I talked a little bit about last year. You probably saw or heard the impact that venture took in terms of number of deals falling drastically, capital being deployed falling drastically. I'd say that from my perspective of March 2024, it's stabilizing a little bit. I'd say the dip isn't dipping anymore. That's my perspective. Data is usually 1 quarter. There's a 1 quarter lapse between whenever you see the data. So we'll see what the end of March has for Q1. But that's it. We spent more time than I had originally planned to go over all of this, but we want to leave time for questions. I'm happy to go over any questions on any of the prior slides, or love to open the floor for any other questions that any of you might have about not fundraising related. Maybe it's market or business model, etc.
Hi, yeah, it's Alyssa. Thanks so much for this. This is great. Question for you is, how do you all think about traction when you're pre-revenue, or what are some of the best ways that you all have seen companies show traction when they are pre-revenue?
Sure. So I can answer, and I would love for my colleague Waverly to answer as well. I'd say it also depends on, is it B2B or B2C? That said, if we eliminate that for half a second, you want to, as effectively as possible, show that there is demand for what you are building or wanting to sell. So whether that's wait lists, sign up forms, letters of intent, or proof of concept contracts with people, you don't have to be actually getting the dollars in the door right then at that time, but you're saying, hey, this is a way that people are using the product or want to pay for it. That said, there's other avenues where you can maybe create some sort of an MVP that people are using. Maybe they're not paying for it, but maybe there's a way to show a component of the product that people do find value in, and they're using. Again, maybe they're not generating exact revenue in that point in time, but the goal would be to roll out revenue in the future. But Waverly, I don't know, feel free to chime in.
Yeah, I think the only other point I would emphasize, which you alluded to, but is for a pre-revenue company, I think the two big things that investors might be looking at are who is your clear target customer and what's the value proposition that you're providing to them. And so any type of traction metrics that can help crystallize and emphasize and make those points really specific, I think are super helpful when you're pre-revenue. So I think those will really be the biggest questions that investors might have for you.
Thank you.
Yeah, customer interviews, all those things. You just got to hustle your way to show, hey, this is real. People want this, and there's value in it. They want to pay for it.
Hey guys, are you actively investing right now or not, Slauson?
Yeah, we are. We can drop we can drop a link for you to share more about what you're building, and our team reviews that and gets back to founders.
Okay, and you guys do pre-seeds even if you haven't raised no money so far, like zero investors? You guys go for pre-seeds or not really?
Yeah, we do pre-seed and seed, and we have an accelerator called Friends and Family. So we look at, because of those three categories, we look at companies across lots of stages and business models.
Thank you guys, much appreciated. Thank you.
Any other questions from folks? Justin, please.
Yeah, I'm curious how you guys, if you have any, like, if you have a preferred method for market size calculation. I feel like I've seen a ton of content around that, and just like some valuations, to your point, in the past have been just crazy. So I guess I'm just curious what your guys' thoughts around there are, like red flags or any like preferred frameworks, I guess.
Yeah, Waverly, do you want to, or Eileen, chime in around market sizes?
I know that's super generic questions. Sorry.
Yeah, I think Jesus kind of highlighted how we might think about it, which is really sizing the potential number of customers and then how much they would pay. And so I think as long as you can articulate your process and why you've gone about it that way, I think that the methods can vary, but it's more so about being crystal clear on like why you went about it a certain way. When we're doing market sizing for our memos, for example, it's more so we do both the bottom up and top down market sizing, but it's more so explaining why we discounted things in certain ways, or like why we focused on this pricing metric or size of the market in terms of customers in this way. So there's a lot of nuance in it, which is why we had market sizing as part of quantitative and qualitative points. But to the extent that you're able to be specific around your process and your inputs, I think that that's super helpful.
All right, cool. So just kind of show your work and be able to justify your thought process. And then when you said both bottom up and top down, are you doing that on every deal, or you mean like either or? Are you like?
We do it for deals that we do a memo on. We do it for every deal.
All right. Cool.
Yeah. And we don't do a memo for all the companies that we talk to. Typically that happens after we've had 3 to 5 conversations with a company. And just to clarify, for those that aren't familiar with bottom up, top down. So bottom up is what I gave an example of earlier. You have a software for car washes. There's 100,000. We'll keep it simple. There's 100 car washes in the US. You're charging each one $1 in yearly revenue, if you will. So multiplying those to your market size or your product is $100. Again, I'm making it oversimplified. Top at the bottom up. Now we would, if it's $100, then we're not going to assume that you're going to go after, you're going to be able to generate all that $100 in day one. So we're going to discount that by what are you actually, based on your geography, based on how robust your product is, based on the features, what percentage of that are you going to actually be able to get? The top down is how much revenue is the car wash industry generating? That's a different metric, but so for example, research papers or studies might show that, hey, there's, again, if I use the $100 example, there's $1,000 in the car wash industry. That number probably takes into account how much you and I spend to go wash our cars. So that's, all of how much people on soap and utensils, like soap and supplies and everything, electricity that they have to pay and water usage. So like that number is likely going to be a lot larger than what your specific product is. But we want to understand how big it is. And don't worry too much about your calculations. The investors are always generally going to use that to start off with and then make their own assumptions based on what they view to be true. Paolo.
Hey, Jesus. Hey, Waverly. I've got two quick questions. So the first one is around valuation. So last year, the landscape was definitely tricky, but now things seem to be picking up again. What are your thoughts on how that's going to evolve over the next 24 months? And then maybe second question just quickly is around dilution for a pre-seed. So especially in the B2C space, I mean, at the beginning, it's a bit more capital intensive. Then if things go well, then it kind of tapers off over time. But what do you think kind of the ceiling is for a prudent maximum dilution for a company at this stage?
So in terms of valuation, I know Carta publishes a lot of data, and it's very useful insights that shows number of companies raising, valuations, deal sizes. My perception of what happened last year versus 2021 is the number of deals fell drastically, the number of capital fell drastically, particularly at the seed. I haven't seen a lot of data as much data at the pre-seed level. For seed, the valuation didn't drop as much as it did for other categories. So without having graphics, it's hard, but Series A plus, the valuations fell like 40-50% last year versus 2021. From what I've seen, seed deals and therefore indirectly pre-seed deals did not fall as much. It was probably somewhere between like 5 to 15, maybe maximum 20% of a dip. So what that translates to me is that the seed deals that were getting done were likely very strong deals, and the deals that were not done were ones that were being done in 2021, but maybe for different reasons shouldn't have been getting done, and therefore the deals that were able to maintain a fairly consistent valuation were ones that, again, were strong product, strong revenue, strong team, probably a combination of all three of those things. And so going forward, I don't think we're going to see a super strong correction one way or another in terms of seed deals. I will say there's probably still a slight decrease in valuation, but again, it hasn't been drastic. That's my perception. In terms of dilution, so I'd say we've seen dilution of a pre-seed round up to like 35%. Again, that's to our earlier point. that's probably a yellow borderline red flag. But if the company or the product is interesting enough, hopefully the investors will want to dig in and understand what's happened, understand the nuances with the round and the company's trajectory. And so where you would ideally be is around 20%. But to your point, which is very valid on the consumer side, up to 30%, I wouldn't think it's crazy. But again, the implication is that once this thing takes off, you're going to be able to raise still a large amount of capital to build a large business, but at a much higher valuation that will make up for the fact that you had to take on so much dilution, and hopefully avoid a down round or a recap, because recapping at a early stage deal generally isn't favorable for neither the investors nor the company. So hopefully that answers or gives a little bit more nuance there.
Yeah, that was useful. Thank you.
Time for one more question.
Guys, first of all, I want to say thank you for doing this. It's so much information. I appreciate it. Thank you for taking the time. Two questions. I'm so new into this. That's why I'm so naive. When you are in pre-seed, can investors ask for a board member chair to be part of the board members? It's usual to be asked that. And the second question, let's say someone asks me for 30% percentage exchange on investment, right? Does that 30% goes down as future investors comes up? Like the investment, this gets you got a point.
Yeah.
Thank you for your question. Thank you.
Yeah, no, this is why we do it. So don't feel bad about asking the questions. If you have it, I guarantee you somebody else has the same question. To answer your first question about the board, so that depends on the firm itself. That's actually a good question to ask whenever you are having conversations with investors. For Slauson, we do ask for a board observer seat, which is different than a voting board of director seat. There's reasons why we ask for a board observer versus a board of director seat, but every firm has. I say a rule of thumb to think about it is if a firm is leading your round, by leading I mean they are setting the terms, they are issuing a term sheet, etc. It's highly likely that they're going to take a board seat. But there's other investors that are going to come along and not and be follow-on investors, and that's where you want to really understand, what do you require? Do they require side letters outside of just a board seat? Maybe they have other requirements for like reporting or something. So you want to ask those questions whenever you're having conversations with investors. Do you take board seats? What are your average checks? How much ownership do you typically look for? Are you active? All the questions that we've already hit on. To your second question around dilution, the short answer is yes. Whenever you raise another round of capital after already having raised capital, everyone gets diluted. The caveat there, and you might have heard this analogy, is the pie gets bigger. So more investors are taking more ownership or more pieces of the pie. But whenever you're a $5 million, your company is valued at $5 million, let's say it's here, and then you raise another round, it's $15 million. The pie and the value of the company is bigger, but you've had to give up some other percentage. You can typically the amount of capital that you're raising. So let's say you raise $1 million in a pre-seed round, and you give up 10% of the company. So you raise 1 million out of 10 million, and then you're going to raise another 10% for $2 million. Which is another 10%. The investor that put in the first million is going to be diluted by 10%. So instead of 10%, they're going to go down to 9%. But you can do it quickly in Excel and figure that out. But generally, yes, everyone else will get diluted. And the last thing, because I know we're at time, typically that's why investors want a pro rata requirement in their term sheets. So we ask for pro rata. What that means is whenever you raise another round of capital, you're allowing us to put in more money in that next round so that we actually aren't diluted by that 10% or whatever amount you're raising. So in this example of the $2 million round, 10% of that is $200,000. We would then give you $200,000 of that $2 million round so that we, your first investors, can maintain our 10%. And we would ideally do that up to a certain point so that hopefully you're a $10 billion company and our 10% is a lot of money.
Makes sense. Thank you.
We're over time. Thanks everyone for joining us. We do these once a month. Keep an eye out on our socials for signing up.